Let me start by thanking Edward Robinson and Steve Davis for the invitation. I think this may be the third time I've been at this forum, and the ballroom keeps getting bigger, the stage keeps getting higher. It is a measure of the success of the forum that Edward described last night. It is hard to disagree with such a literate and sensible paper as Eswar has written, but I will do my very best. I will try to keep things lively by highlighting those aspects where I do disagree, at least to an extent. The key sentence of the paper, if you will, is where Eswar writes, by some measures, the primacy of the dollar has hardly been affected by U.S. economic policies and political dysfunction, the erosion of U.S. institutions, or the weaponization of the dollar through financial sanctions. So, true up until now. As I write, past performance is no guarantee of future returns. And there are many people who are wondering whether we could be approaching a point where the erosion of dollar dominance begins to accelerate dramatically. And I think there is a tremendous amount of history suggesting that international currency status does not remain immune indefinitely from the kind of institutional and political problems that we are witnessing in the United States. So Eswar emphasized the domestic dimension, the erosion of rule of law, separation of powers, Federal Reserve independence, and so forth. But there is also an external dimension, the fraying of U.S. alliances, the observation being that central banks and others hold and use the currencies of their alliance partners for cross-border transactions. Disproportionately, they regard those alliance partners as reliable stewards of their reserve holdings. They regard holding and using the currencies of their alliance partners as a show of good faith. So when we hear about threats to NATO or the U.S. scaling back its troop deployments in Germany and Poland, that's relevant to what may be coming next. So when I look at the same data that Eswar looked at, I am a bit more worried by the overall picture. As we saw, the share of global reserves held in dollars has declined from a bit more than 70% of the world total at the turn of the century to a bit less than 60% of the world total now. The share of U.S. treasuries held abroad has fallen since the global financial crisis. Convenience yield on U.S. treasuries has fallen. That there have been continued financial inflows into the United States tells us something about the perceived health of the U.S. economy, but it doesn't necessarily tell us very much about the prospects for the global monetary and financial system, and there have been hiccups to the dollar's safe haven status. It did not strengthen after Liberation Day. It rose by only, in quotes, 1.5% in the first week or so after war broke out in the Gulf, and it's remained pretty much flat since then. Small bump by historical standards. Moreover, I don't think Tina is a convincing argument in this context. We have to use the dollar because there is no alternative. Even if there is no alternative, there can still be a crisis of confidence in the dollar and flight away from the dollar. So, everything reminds me of the 1930s, and this reminds me of the 1930s as well. There was a sterling crisis and a liquidation of sterling reserves. In 1931, there were then 3 big banking crises and a liquidation of dollar reserves subsequently. So, we tell our students about the downward spiral of world trade in the 1930s, and we point to the Smoot-Hawley tariff and retaliation. Another dimension of the same problem was the liquidation of foreign exchange reserves, a global liquidity shortage, and not enough trade finance to grease the wheels of globalization. So that's a scenario we've seen before. As alternatives to the dollar, the paper says very little about the euro. Sorry Philip. It downplays the role of the Chinese renminbi. It emphasizes gold and dollar-linked stablecoins. As I will elaborate in a moment, I think this exaggerates the risk from stablecoins, and it downplays yet other alternatives. Eswar did mention in his presentation non-traditional reserve currencies. There are also linked fast payment systems, tokenized bank deposits, CBDCs, which all provide potential alternatives. The euro was created to provide an international alternative to the dollar, but it hasn't really turned out that way, as we heard. So one of my dear friends, Arnaud Mel, is heavily responsible, I think, for the annual report on the international role of the euro, from which this composite index of the euro's role comes. And I'd like to have fun with him whenever I see him. This looks like the electrocardiogram of a dead person. It doesn't move around very much for obvious reasons. There have been existential doubts about the euro, which Mario Draghi finally put to rest a decade plus ago. There remains a shortage of safe euro-denominated assets. Only 3 or 4, depending on how you count, euro area sovereigns have AAA ratings from all the major rating agencies. Markets in those safe assets are siloed. Ability to project foreign military power, foreign policy power, and currency power tend to go together, and Europe is not there yet. This might now change. There is clearly in Europe a new sense of urgency around the continent's reliance on the United States and the dollar for international monetary and financial services. So steps may be coming. There are proposals out there from many people, from Olivier Blanchard and Angel Uribe, to create more euro-denominated safe assets where the Commission could buy up a quarter of the member states' domestic bonds and issue European Union bonds in analogous amounts. The capital markets project is underway. It needs to be finished in order to create a more liquid market in those bonds, although there is resistance from Commerzbank and fund managers in Ireland, sorry, Philip, and Luxembourg to pushing ahead with capital markets union. There is a new sense of urgency around creating a defense union, although, Mario Draghi's report, which emphasized that member states produce 11 separate types of tanks for their common defense, that problem remains a problem. So will anything happen? I do think there is a new sense of urgency, but it will take time for the obstacles to wider global use of the euro to be overcome. On gold, there is the point that Eswar emphasized in his presentation. Central bank accumulation of gold creates risk of a price fall in a financial crisis when central banks need foreign currency liquidity. I agree with that, but there are other problems with relying on gold for reserves as well. A wide variety of countries have been repatriating the gold that they traditionally held at the Bank of England and the New York Fed, partly because of sanctions-related risk, partly because of nationalism. Marine Le Pen famously writing the governor of the Bank of France, insisting that the bank repatriate the gold that it held in the United States. So generally speaking, gold is awkward for use in payments. And when it's vaulted at home, it's sterile. It can't be used for financial transactions. It can't be used as collateral. It can't be lent, etc. It lacks the liquidity, as Eswar put it in his presentation, of other forms of reserves. This is from an earlier version of my presentation management that I thought we had superseded, but we didn't. Another interesting development here is the importance of China's cross-border interbank payments system. Eswar made the point in his paper that CIPS continues to use SWIFT, apparently, for the majority of its messaging. So SWIFT effectively picks up many of the transactions that go through CIPS. What is not so widely appreciated is that transactions through CIPS have stalled out as well. So these are billions of dollars of transactions through CIPS per day. There was basically no growth in 2015. So the system had been growing at double-digit rates for a while. It stopped growing at double-digit rates last year. There was then an interesting bump when the war in the Gulf broke out. Apparently there was significant movement from other clearing platforms onto CIPS. And then when there was a ceasefire declared in April, that went into reverse. So CIPS is being viewed, I think, as an alternative to the U.S. correspondent banking system and the dollar. And when worries about the latter are heightened by events, there is some migration toward CIPS, but there can then be migration back in the other direction as well. On those non-traditional reserve currencies, growth in holdings of them accounts for 3/4 of the global reserve market share that the dollar has lost since the turn of the century. The renminbi accounts for the other 1/4, the euro for nothing at all. And you can see what those currencies are: Australian dollar, Canadian dollar, New Zealand dollar, Singapore dollar. They all have to be named dollar for some reason, or the various krona of the Scandinavian countries. The South Korean won is on that list as well. They provide some diversification benefits, and they have become easier to buy and sell. So you can see here what's happened to bid-ask spreads. The blue line is for the major reserve currencies vis-a-vis the dollar. The red line is for these non-traditional reserve currencies. This is the advent of digital trading platforms and the like that have made it more economical to get in and out of these currencies, that have made them more liquid so that they can be used more widely. And if you look at the SWIFT data, this is probably too small to be readily visible. You can see them beginning to catch up with the majors in the payment sphere as well. So this is an example of digital technology beginning to change the architecture of the global monetary and financial system. On stablecoins, Eswar writes, stablecoins backed by major corporations such as Amazon and Facebook are likely to gain traction as means of payment. So I agree with this, except I would change likely to unlikely. There are several problems here. Stablecoins may not be stable. It depends on how vigorously the regulations and effectively the regulations about backing and the like are enforced. And we have a lot of history around private monies that suggests that regulations on the books do not always translate directly into effective regulation. That's the free banking era in the U.S. in the 19th century. For example, stablecoins may not be fungible. To use Eswar's example, will we be able to use Amazon coin at Facebook and Facebook coin at Amazon? Will there be exchanges to provide seamless conversion of one to the other? And I think above all, there's a lack of recourse. In other words, who do you sue? Who do you go after if the payment goes missing in transit? The validator at the node that validated the transaction, the issuer who has long since gone from the transaction, the exchange on which the on which the coin moved. Not clear what the legal recourse will be. Where Eswar emphasizes the risk of dollar-linked stablecoins to emerging markets and developing countries, I would emphasize the risk they pose to the U.S. Treasury market. If Scott Besson's dreams come true and dollar-linked stablecoins are backed by $3 trillion worth of U.S. Treasuries, and then there is a run on stablecoins, that will be a nightmare scenario for the U.S. Treasury market. Eswar writes, national currencies issued by emerging markets and developing economies could lose ground to private stablecoins and perhaps also to CBDCs issued by major economies, they could lose ground for other reasons as well. I'm thinking about local currency settlement initiatives, instant payment systems that are linked across economies. So Singapore's instant payment system, people in the room will know, is linked to those in Thailand, Malaysia, and now India. So they can be used for retail transactions today across borders without going through the dollar. Somebody has to call up a dollar dealer and find out what the relevant exchange rate is, but otherwise they don't have to go through the dollar. And if you're concerned about wholesale transactions, you have these digital platforms like Project Enbridge. This is a People's Bank of China project. The code was written in the Digital Institute of the PBOC, but its tentacles now extend to the UAE and Saudi Arabia, where it is potentially used for oil-related transactions, construction company-related transactions, among other things. Again, these are alternatives at the retail level and the wholesale level to going through the dollar and the U.S. correspondent banking system. So finally, on reserve pooling or global liquidity in insurance, I think we've known for a long time. Danny Roderick reminded us 20 years ago that holding reserves has costs as well as benefits, and there have to be more efficient alternatives, in theory at least, to self-insurance. There have been a variety of attempts to overcome this problem. I think in particular about the Chiang Mai initiative, multilateralization in this part of the world, never activated, never utilized, a good idea that has proven sterile in practice. I think the explanation is lack of confidence in the partners, so the partners continue to heavily self-insure, and when there is a bout of volatility, they do not go to the CMIM. So Eswar's proposal in its current incarnation sees the Bank for International Settlements as the steward of this system. Would there be confidence in the BIS as a fair broker in a crisis? The paper concludes by discussing two unsavory, language of the paper, alternatives that the world faces: continued dollar dominance versus a fragmented currency system. I prefer the word multipolar to fragmented. I prefer the word diversified to fragmented. I think there are advantages to an overlapping, diversified set of liquidity providers not being solely reliant on the good offices of the Fed and Kevin Morris to extend dollar swaps the next time things go wrong. So I analogize the advantages to planet Earth of a diverse ecosystem and the advantages to the global monetary and financial system of multiple sources of international liquidity. Would such a system be stable or unstable? We've seen examples of both in the past. So if you look at cross-border payments before 1913, gold never moved to a first approximation between countries. What moved was pound sterling, French francs, and German marks, and that system worked well because the underlying policies of the issuing central banks and governments were themselves sound and stable. In the 1930s, the underlying policies were anything but sound and stable, and that system worked poorly. So how a more diverse, multipolar, fragmented, if you will, system would work will depend, as with many things affecting the world economy, whether the underlying policies of the major powers are sound and stable or not. So thank you for your attention.
Thank you very much. And thank you very much, MAS and ABFER and NUS for putting together such a wonderful event. Thank you, Eswar, for such an excellent, thoughtful paper that gets us thinking about some very important issues. Like Barry, I'm not up here to criticize any specific thing in Eswar's paper, although I think Barry did get in quite a bit of barbs on the paper itself. I'm not going to. I'm going to try and discuss the paper in a way that I hope will come across as trying to extend the reach and the compass of the thinking that appears in Eswar's paper. The question that I'm going to address is this. Eswar concludes by saying that it's going to be, there's no evidence, all the evidence points against how we're going to be able to change or disrupt a US dollar dominant international monetary system. A way that we typically think about doing that is we think about alternatives to the dollar dominant part of the dollar dominant international monetary system. But we don't typically spend a lot of time thinking about the system part of the IMS. Eswar does do that when he talks about the global liquidity insurance mechanism. But the IMS, of course, is more than just insurance. It's also a way by which countries exchange value with each other. It's also a way by which countries store value. And obviously, it's the unit of account. It's the traditional money. But beyond just that, it's even more. So when I phrase this question, and I want to think about the system, I need to compare it to something else. The international monetary system today's international monetary system came to being at the end of the Second World War with Bretton Woods. It came into being at the same time that what many of us think of as the rules-based multilateral liberal order came into being, centered on the United States and centered on the overwhelming power, the unipolarity of the United States in the global economy and in the global polity more generally. So when I phrase the question this way, and I try and compare the two systems, what strikes me is that world order seems to be changing dramatically. The rules by which international trade are occurring are transmogrifying. Countries are trying to figure out different coalitions of the willing by which they can organize their international affairs. And as we saw yesterday in Michael Spence's talk, the United States seems to be zigging when everybody else is zagging. It's going in quite complete directions. So why is world order, the system by which we organize the international affairs of the world, so capable of change, while the international monetary system seems stuck at the 85% marker for the US dollar, for dollar dominance? I want to argue that if there is change, it's not necessarily going to come from our looking at the statistics on the US dollar. In other words, US dollar dominance is not necessarily the sufficient statistic for how the international monetary system might be changing in a way that parallels world order. If you like, there's going to be quite a lot of detail that I'm not going to mention in the 17 minutes or so that I have now. But if you like, you can bring up your personal device, scan this QR code, and follow along in the slides that will be available. While you're doing that, let me tell you why I think world order is changing, and that's the background against which I want to contrast the lack of change in the international monetary system. World order is changing for three different reasons. One, different countries, different groups are recalculating the costs and benefits of their being part of a US-centered, unipolar, liberal order. They see parts of it that they like. They like rules-based. They like a level playing field. They like enough of multilateralism but they don't necessarily go in for everything else that came with the US-centered, unipolar, liberal order that emerged from the Bretton Woods era. So the first reason, countries are recalculating costs and benefits, and they're finding those margins changing, and they're going where economic logic tells us they should go. They should try and maximize benefits relative to cost. But that's not the only reason the world is changing. There are two more. The first is the United States is now acting in a way that distances itself from the order that it built. It is backing off of rules-based multilateral order. That is a profound change in the way the world is organized. We see that in the way America seems to be exiting from many of the international organizations around the world, and it's doing things in a way that no longer supports the globalization that we have come to associate with the liberal rules-based order. But let me quickly get to the third reason, which is the United States is not just withdrawing, it is actively disrupting world order for the rest of us. Okay. I am not a shrill, strident, global South third worlder when I say this. Adam Posen says this. Adam Posen at the Peterson Institute describes how America has transmogrified from a global insurer to an extractor of profits. Now, in the light of all of these actions, it is not a puzzle that world order is changing. The question is, are there parallels in the international monetary system to how we see world order changing? And I want to argue that there are. So I want to get to how I want to address a number of questions about the international monetary system relative to world order. But I want to also be sure I very quickly say Eswar's conclusions completely convinced me that US dollar dominance is still on the table. Barry EICHENGREEN is a former teacher of mine from graduate school, and I appreciate how he is critical of this idea. But the evidence that Eswar presents quite solid, and unless we believe that there's something wrong with these numbers, which I'm going to try and argue, we need to continue to believe in dollar dominance. So dollar dominance shows up in the shares of international payments. It shows up in the shares of trade finance that's financed by the US dollar. And it shows up in the lack of viable alternatives. And Eswar says that the choice that we have is very simple. There are two unsavory alternatives, dollar dominance or fragmentation. And fragmentation is inefficient. We don't want to go there. But we can try and build things that ameliorate the inefficiency. He points to how countries are indeed eager to disentangle from the US dollar-dominated financial system. So I want to pick up on those points, build on how there's an analogy with what's happening in world order. There are three questions whose answers I want to leave you with before I step away. First is, Eswar modulo Barry's qualifications. Eswar says there are no viable alternatives, so the US dollar should, of course, continue dollar dominance, simply mechanically. But let me suggest that perhaps it does not matter whether dollar dominance continues. Set against the background of why world order is changing, perhaps dollar dominance continuing is neither here nor there. So that even if there were viable alternatives, the world would still choose an equilibrium where dollar dominance continues. I want to then very quickly describe how world order is changing, and I agree with Barry that today, the way world order has gone, fragmentation, which is the other unsavory alternative that appears in Prasad's paper, fragmentation is no longer a searing indictment, because fragmentation can be viewed as multipolarity and as diversification. And those are no bad things. Not only are they no bad things, they are things that we already, and therefore tolerable. They are things that we already see in the world. That is already happening. So it is not that we either have to stick with dollar dominance or we go fragmentation. We're already seeing fragmentation. And then third, I want to suggest that perhaps dollar dominance is a red herring. And the reason I want to say that is that if we look at the international monetary system in light of how world order is changing, we need to ask, what are the critical bottlenecks that don't exist when countries go off and reform the initial WTO centralized universal multilateral trading system into separate groupings that are leaderless, that are plurilateral, that are not fully multilateral, but simply multilateral enough? How are countries able to do that and not do the same for the international monetary system? So I want to argue at the end that the reason they don't do that is not because of the US dollar as a currency, but because of the pipes and conduits that we have built in the international monetary system. And those pipes and conduits can, in principle, flow any currency or any other value. If the international monetary system is going to change, if there are fragilities in the IMS, it's in the pipes. It's not in the currency. And I hope that I'll be able to say a little bit about the alternative pipes that are being built that don't show up in values like how we measure currency dominance. But those pipes in the form not just of SIPs, but of Project Enbridge and Project Nexus, which are multilateral based, initiated together with the BIS Innovation Hub, and in collaboration with groupings of countries, which do include China, but also include Thailand, Singapore, Malaysia, and a range of others. Okay, so I have told you the points I want to make. I'm going to trust that if you don't believe me, how the reasoning goes, I hope that the slides help carry you part of the way, and there will be a paper soon. But let me just highlight some of the things that happen in these slides, because I don't have very much time. The way in which the world has decided on transforming world order, in my view, not IR scholars typically might not do this kind of accounting, but I'm an economist, and when I study IR issues, this is what I do. I look at the costs and I look at the benefits. But I also appreciate that when you're transforming a system, it is not single-player costs and benefits. It is distributional. Some of the costs of the current system or of the change in the system will fall on some parts of the international community. Some of the benefits fall on some players, not on all players. So when we do the accounting, the systemic accounting for either world order or the international monetary system, to make that comparison, I think about one column, which is core gains. These are the benefit side of an international system. Typically, they happen to fall on the core or the center or the kernel of the system. If it's a US-centered unipolarity, it will fall on the United States. And then I think in the other column of perimeter losses. These are things that fall on others. So for instance, when we think about economic growth, core gains are that all society increases the capacity. Perimeter losses are that there are some losers as income inequalities change, but they are not central. They're not core. The international monetary system shares together with large ideas like economic growth, trade. Sorry, this came back. The International Monetary System shares with things like economic growth and trade the idea of there being gains to the core and losses to the perimeter. So the International Monetary System has gains to the core and for everyone, increases in efficiency, improvements in insurance, reduced transaction costs and frictions, availability of liquidity, safety. But in terms of a gain to the core, it also allows the center of the International Monetary System to weaponize economic interdependence. It allows economic statecraft. In the words of IR scholars, such as Blackwell and Harris, the International Monetary System is a piece of the economic tools that the United States has to wield its power in the world, to bend the world to its geopolitical will. Everybody who's part of the core gets to do that. While this is part of the gain to the core, it is a loss to the perimeter. It washes out. It's system-wide. Until the perimeter gains enough power, this balance, weaponization doesn't matter, and we're stuck with traditional economic ideas we keep to the International Monetary System. The key conclusion from this is that when we're looking at whether the International Monetary System is going to change, we need to look at distributional gains and losses, not just single-user costs and benefits. And when you look at distributional gains and losses, the question is, how does the landscape of the world rack up when it adds up what the gains are and what the losses are? And if it adds up in such a way that the gains remain dominant, we will keep with the old system. Okay. The takeaway from this is that US dollar dominance remains a feature of the international landscape. But here's the thing, that calculation of costs and benefits shows that any other core currency would have the same configuration of costs and benefits. The system itself is indifferent to which currency it is that's dominant. Where identity matters is only in how economic interdependence is weaponized. So the question here for whether the International Monetary System will continue is whether we think America is a worse actor in the world than the other guys, whoever the other guys might be. Let me tell you my guess. America is no worse or no better an actor than anybody else who's potentially the hegemon. We ought to be indifferent to who it is that occupies the central position. World order, I like to think, has a similar calculation. World order, when it began, World order, when it began after the Second World War in Bretton Woods, came in the form of something that we economists learned as Charles Kindleberger's hegemonic stability theory. America was the hegemon and did good for the world. And we all thought that on the distributional gains and losses side, it was a net gain to keep to that. As world order has continued to change, as multipolarity emerged, America saw its cost and benefits calculations change. It became less of a benevolent hegemon. The rest of the world adjusted to that and began to move away from it. Even if they thought that America was the provider of protection against shocks in the world because the hegemon was the provider of insurance, was the consumer of last resort, was the banker of last resort. That calculation has to change when the source of the shocks is now America itself. If America is the source of the shocks, it does not protect us from shocks to the international system. So world order has, in a very rational economic way, transmogrified. It has changed and moved in what Prasad might call a fragmented way, what Barry and I would say a multipolar, diversified way. Now, where does this go from here? What do we now need to think about the next stage of the international monetary system? So I end with this, that dollar dominance might well be a red herring because we, the rest of the world, are not going to be happy with whoever's currency is dominant. We replaced it with somebody else. That someone else could be doing the same calculations as the United States. It would look at the same distributional gains and losses, and we, the rest of us, would still be at the short end of the stick when it comes to weaponization of economic interdependence. Let me repeat. In this analysis, America is no worse or better a player than China or the European Union. I'm just being a realist. I apologize to my friends who might be offended by this, but this is how international relations people talk. So where do we go? So I want to argue that what is really critical, and this is where I'll end, is if we're going to think seriously about changing the international monetary system, it's not going to be in the currency. Because the international monetary system is an exchange network. It is a network made up of conduits, piping, as a conduit, and the counterpart, flows of medium. US dollars are the flowing medium. The pipes that form the way in which the world interconnects, that is what is critical. That is what is invariant. And for now, what is invariant in the world is the SWIFT system, correspondent banking that goes through US banks, and it is that pairing by which the United States exercises economic statecraft in the world. If we feel that the international monetary system is going to move towards one, just like world order is doing, where no hegemon gets to will its way against the rest of us, even if we suffer a bit of inefficiency, it is the piping that needs to change, not the currency. Is the piping changing? I would suggest yes. And I know that I'm out of time, so if I may, I'd just take 30 seconds. SWIFT, whose name has come up several times in our discussion, is not a clearing and settlement system. It does not hold any value. It does not hold assets. It does not pass along any assets. SWIFT is simply a glorified WhatsApp for international financial institutions. It simply sends messages. But when the money actually does flow, and this is where economic interdependence enters, is through the correspondent banking system. So the right question is not whether SWIFT is replaced, but whether the pipes in banks are getting insinuated, subverted. And I want to suggest they are. So let me end with 3 words that I hope you remember. SIPs, the cross-border interbank payment systems that, yes, came out of China, that is a full-blown clearing and settlement systems. It happens to have also tacked on a WhatsApp, like WeChat. It has a messaging system. But it also allows people to use SWIFT as a messaging system. So the fact that SWIFT continues to see business is not at all a surprise, even if SIPs is important, because it lets people carry out their messaging one way, but it then does the clearing and settlement another way. What's more critical are 2 newer projects. Project Enbridge, which Barry mentioned, and Project Nexus. Both of these come out of the BIS Innovation Hub. And both of these end up replacing the traditional piping in the international monetary system through a variety of means. Bilateral exchange of local CBDCs rather than using the United States dollar as an intermediate currency, bypassing the US banking system as temporary holders of financial assets, or simply engaging in creating a single hub that then allows bilateral exchange between countries that are outside of the core. Project Nexus already does that and has gone live. Project Enbridge was incubated at the BIS Innovation Hub and has now been handed over to a conglomerate that includes China, but also Saudi Arabia, the United Arab Emirates, and Thailand. So I suggest to you that we might be thinking about the international monetary system wrong. Now, what we should be looking at is the system as a whole rather than its pieces, and the system as a whole is being moved by forces that are already operating elsewhere in the world. Thank you all very much.
Thank you very much, Barry and Danny. Let me first ask Eswar to respond to the comments, and then we'll open the stage for questions and answers.
Okay. Barry and Danny, who are very distinguished and who I've known for a long time, are extraordinarily generous and gracious. They could have damned me with faint praise, but instead, they took the argument seriously, but more importantly, they substantially broadened the lens for all of us to think about these issues. So they've given us a great deal to think about, both in their specific comments, but in terms of the broader framing of the issues. The paper that I wrote is not at all intended to be normative. It is a positive description of where we are and why we are stuck where we are. Let us dream for a second, maybe a minute. Let's dream of a world in which there are, again, rather than fragmentation of currencies, a multipolar, a diversified world where each currency issuer has strong, well-regulated, deep financial markets, has good institutions that allows the world to trust in those currencies and those financial markets. And perhaps we can even dream even further about a world where we shouldn't even be thinking about reserve currencies. Why do we have reserves? Emerging markets, by and large, hold reserves because they are subject to capital flow volatility, spillovers of policies from advanced economies, because there isn't a good insurance system, so they have to self-insure. And of course, many emerging market economies are doing the right things. They are improving their macroeconomic policy frameworks. They are using exchange rates as a buffer to protect their economies from some of these shocks. But still, they live in a very volatile, a very cruel world in some ways, so they need reserves. So if one was to think in a true blue sky way, I think it's worth asking about these more fundamental questions about why you even need reserves and therefore reserve currencies. That suggests that there are problems in terms of individual countries' management of their economies and in terms of the international monetary system. And the other problem, of course, is that there isn't a clear alternative in the sense that you have trusted currencies that have all the attributes behind them that I spoke about. I have no doubt that a world that is multipolar in a positive sense of the word, where essentially you don't have currencies that are equally dominant because of the weaknesses of the others, but because they're all strong together, would indeed be a very good world. That is not the world we live in. So the description that I laid out is really a function of the fundamental inadequacies in individual countries, including reserve currency providers and in the international monetary system more broadly. So I think the questions that Barry and Danny have put on the table are really important ones. We should think about what the alternatives are. And certainly one could argue there has been progress. Both the discussants made these very important points about how there are improvements in, as Danny put it, the conduits, the pipes in terms of international transactions. And we should be in a world where it's relatively friction-free to be able to transact between different currencies without having to go through an intermediate or vehicle currency like the US dollar or the euro or many others. And I think we are moving to the world where, in fact, payments are going to be much more efficient. But what I find lacking is the other elements of the financial market, regulatory, and most importantly, institutional architecture that is necessary to support all of this. So I would argue that the paper should not be taken as a description of where we are and why we need to get stuck where we are, but about a call to action. As I argued, there are these two alternatives, none of which looks very good. So if we want to move to a better world, let's get going. Let's think about what is really to move to that world. But given the current configuration of economic policy making and indeed politics, not to mention geopolitics, that's going to take a while. And in that configuration, I think the notion that we can move to a world that is multipolar smoothly, I think, might be very difficult to achieve. Not impossible, but it's going to take a lot of work. So as one thinks about what could change, we talked about the conduits that are changing, and certainly as one thinks about the payment channels, they are improving. If you think about SWIFT's business model, and Danny gave us a great analogy of this just being a glorified WhatsApp, this is not a business model that should be surviving to this day. A messaging system that is meant to get around differences in languages, differences in computer protocols, differences in regulatory protocols really should not even be existing in this day and age. If you think about stable coins, which Barry referred to, stable coins I think are wonderful. They're wonderful not because they are solving problems in the right way, but what they have shown is that there are glaring inefficiencies in existing financial systems, especially when one thinks about cross-border payments. And it is possible using technology to get around these problems. I don't think stable coins are really the right answer to the problems, but they have shown that in fact you can get going and use technology in a constructive way to get around these problems. So when I think about the notion of a dollar-backed stable coin sweeping into other countries, displacing domestic payment systems, one example, although I might be oversimplifying and overstating the case here, goes even to the Eurozone. The Eurozone, for all its glories, does not have a well-coordinated, unified retail payment system. As I understand it, it's very easy to move money from a Greek bank account to a German bank account, but paying on the beaches of Greece using your German bank account requires an American-mediated payment system, Visa or MasterCard. So maybe the fear of stable coins pushes other countries, including economic zones like the Eurozone, to get their acts together in terms of doing the right thing. So I think about stable coins as not the answer, but the catalyst for where we should be going. And maybe we should think about all of these problems in a similar light. So as one thinks about where the international monetary system is going, I think rather than even being confined to these notions of unipolarity or multipolarity, I think we should really be thinking about much more fundamental questions. What are the frictions that are besetting international financial markets in terms of payments? How do we use technology and other means to get around them? Why do we live in a world where we have so few reserve currencies, and do we need reserve currencies at all? Do we need reserves at all? And these are the questions that ultimately, I think, will get us to a better world. Thank you.
Thank you, Eswar. So I wrote down many questions, but then I realized we only have 8 minutes left and many central bankers here. I will ask a very small question and then open the floor up. So for small open economies like Singapore, fragmentation creates a difficult balancing act. On the one hand, they have strong incentives to diversify payment systems, reserve currencies, and even trade arrangements. On the other hand, Singapore has the status of a global financial hub and makes it conducive to stay with a dollar-centric system. So what do you think should we do about diversification without creating fragmentation by itself?
Certainly,
all three of you can chime in.
Yeah, actually.
You go ahead.
All right. Diversification of some sort is a very sensible strategy, I think, and this goes, to Danny's point in particular, in terms of currency relationships, but also in terms of geopolitical relationships, and for small economies in particular, I think there isn't a good choice. The difficulty here, again, to use a phrase that both Danny and Barry picked up on, I wasn't quite sure if they used it with derision or if some degree of acceptance, about these unsavory alternatives. And that's the problem. Even if you're looking for diversification, you don't necessarily have good alternatives to choose from. So I think that's the complication, and I don't see an easy way out.
Yeah, so an example would be that Singapore is one of the few Asian countries so far with a stablecoin ordinance on the books, and it's different from everybody else's because it authorizes the authorities to issue Sing dollar stablecoins or US dollar stablecoins or any other currency, I think, denominated stablecoins as well. So a small economy can diversify.
Thank you for that. The Singapore draws on the strength of the international system in very specific ways. In my sense, it doesn't feel that it has to accept the whole package. It wants certain dimensions of it. They have to do with a level playing field, peaceful dispute resolution, commitment to cooperation. And so those are the things that really matter to it. So, and I think we see that reflected in the choices that it makes in how it becomes a financial hub. It will go with whoever's got the largest, deepest, most liquid pool. At this point, it's the United States. But it has no further commitment to that. In fact, we see that in the way that Singapore practices trade arrangements. It is part of the WTO multilateral system, but it's also a firm fan of bilateral free trade agreements. It wants the WTO to continue, but is quite happy to fork off into multi-party interim arbitration agreement, future of investment trade and partnership. It's part of RCEP. It's quite happy to be part of CPTPP. It's quite happy to fork off in different directions as is opportunistically gainful. And I think that's the right thing to do. So it's promiscuous. There's no strong commitment to one given system.
Thank you. Let me open the floor for questions. Steve, then.
Thanks. Super stimulating. Yes, super stimulating set of comments. Briefly, I want to start by just drawing a distinction between, that was implicit in much of the discussion, between dollar dominance and vulnerability to U.S. financial coercion. This was a big theme in Danny's remarks, that there's a distinction between the conduit or the piping and the medium. And Barry had some evidence of this in play in the wake of the U.S. and Israeli attack on Iran in March 2026, and then its unwinding. However, the escape, and so there's a desire to escape from U.S. coercive power in the financial monetary arena, and that's in play. However, escape from U.S. coercive power is not the same thing as insulation from a generalized crisis of confidence of the sort that Barry described in the 1930s. In that sense, I do not think dollar dominance is the red herring. There's a separate set of issues around the role of dollar dominance and the lack of good alternatives that Barry stressed there. So I think it's worth keeping that distinction in mind. I do want to disagree profoundly, and I'm going to disagree with you too, Eswar, in just a second. But I do want to disagree profoundly with Danny's statement that we ought to be, or in fact are, indifferent to the identity of the hegemon. It matters tremendously whether the hegemon pursues its self-interest in an enlightened, forward-looking, reputation-conscious manner or transactional, short-sighted manner. And I think much of where we find ourselves today and why there's so much consternation is because, by and large, the U.S. operated in the former manner for much of the post-war period and has clearly not been operating in that manner more recently. And that has given rise to the situation we find ourselves in today. Let me come to Eswar's proposal, which didn't attract much discussion from Barry or Danny, about encouraging a movement away from the use of foreign exchange reserves as a form of self-insurance. I I want to express a somewhat more skeptical stance towards that. I'll put it provocatively, maybe more so than it warrants. But one way to characterize this proposal is to set up a new international body of unelected, unaccountable experts who will assess the quality of each country's policies, its macroeconomic policies, and set premiums based on that assessment. Now, these experts won't suffer the consequences of misjudgments in this respect, including misjudgments about matters which are intrinsically extremely hard to assess, like how much global systemic risk is there out there, and how vulnerable is each individual country. These are beyond our capacity as professional technocrats. So this sounds to me like a recipe for more resentment towards globalist elites. One last comment on which is there's enough of that around in the world already today, including in my home country. One last observation about this. It's not a pure insurance proposal, okay? It's also a proposal to create a mechanism to compel state contingent transfers to certain lower credit quality, less responsible countries from a set of rich countries, which is why you need to have some mechanisms to kind of compel their participation. So I'll just leave that on the table, and you can respond as you wish.
Sure. And then Danny.
So I will start by forcefully disagreeing with Steve on his forceful disagreement against my views. So it is not a proposal. So the IMF has this approach, the flexible credit line, where basically it decides based on its own assessments whether a country meets a threshold for qualification or not. The proposal I have would not have any information to the markets. It would be a set of clearly defined principles. If you have a deficit above this level, if you have a current account deficit above this level, these are your premiums. So the entire market would see this, so there would be zero value that the market sees from your need to get insurance. And when you speak about concerns about the elites, you know, self-insurance is extraordinarily costly for emerging market economies in terms of the sterilization cost of reserve accumulation, in terms of foregone investment opportunity. So one can easily think about a way to make the cost even lower. And, you know, I have specific details where one can think about a premium as about 2 to 3%. Now, the other important element is that this is not a transfer of money to countries that are insolvent. Like I said, it's a liquidity line that gives you access to a line of credit for a year. And if you want to renew it, you basically have to pay the money back. And this does not solve solvency problems at all. So the two key things that it deals with are the following. It enables you to separate out liquidity versus solvency problems because all you get is the short-term line of credit. And second, and very importantly from the point of view of global imbalances discussions that we've had, it separates out precautionary versus mercantilist motives for reserve accumulation. There are many countries that accumulate reserves, and China for a period was accumulating reserves for mercantilist motives. But if you provide an insurance scheme that basically makes it clear what part of your reserve accumulation is for each purpose.
Danny and then Barry.
Thank you. I want to respond, Steve, to a number of points that you made. On one, what we think of for the identity of the hegemon and the currency associated with that. On this, I fall back to Adam Smith, the way that you and Mike Spence did last night. What Adam Smith said was that you described sort of a good version of the hegemon that we've had for the last 7 decades. But Adam Smith also said, it is not from the benevolence of the butcher, brewer, or baker by which we expect dinner on the table, but from their regard to their self-interest. The set of rules that we played under had America deliver good things to the rest of the world. There's a genuine question out there why the action of the hegemon are now so different. Right? And here there's a view that I think both you and Mike expressed that said, well, it comes down to who's in the White House. Donald Trump has been the disruptor. And when the next election comes around, things might change. With all due respect, I disagree with the two of you. I think America has been on a journey that by which the Trump administration is a symptom as much as a cause. And those long-run dynamics come out of America's calculations, and every country's calculations, about what it gets out of engagement in the global economy. I think those calculations have changed. They have made America now depart from the rest of the transatlantic Western European liberal democracies. America took sanctions against Iran and took action against Iran in a way that diverged from its transatlantic allies. I think there's a lot of evidence one can build that says that we, simply as a matter of prudence, we cannot rely on America or any hegemon going back to showing benevolence. It's just not in their nature. Let me end with John Mearsheimer, your colleague from Chicago. Mearsheimer said, many Americans like to believe that in our engagement with the rest of the world against China and others, we behave differently because we are a democracy that loves freedom and is law-abiding. Mearsheimer said, in international relations, we are nothing of the sort. We need to think about how we behave in a way that serves our self-interest, and the rest of the world simply needs to adjust. That's what I'm suggesting the rest of the world do.
Everyone who's worked on financial crises, everyone on this stage, most everybody in the room, knows that the line between illiquidity and insolvency is rather difficult to draw in practice. So what happens when a country gets a liquidity line for a year and then it can't repay because it has descended into a solvency problem? There are going to be losses for the insurance pool. What is that going to imply for the willingness to go forward with this pool in the future?
Thank you very much. This was a very stimulating morning. Eswar, you have shown that dollar dominance is still with us, and even though it may have been some decline, almost secular by now, that it is with us. But I don't think that you have shown that we are stuck, which is also something you said. I would actually argue that right now a lot is moving behind the scenes. I mean, if you think about the European case, the full-on assault on the European mindset, let me put it this way, is only 12 months old. There is the trade war, there is the withdrawal from, I mean, Danny, you have called it from the NATO, not quite yet, but definitely putting a lot of question marks around it. There is the question how the US is behaving in Ukraine or not behaving. And then there is the expression, the verbal assault on European values, all of that. And then there is Greenland, right? Remember that. And all of that, will it just be forgotten? Does it do nothing? No, it doesn't. It's just that you might not be seeing it yet. That is what I would venture. And that speaks a bit to the TINA argument. I mean, Barry, you have been saying this many times. I've heard you say it many times. TINA is not a protection. One way of thinking about this, but I hear this all the time from the markets, right? This liquidity is, they think, it's almost as if it was water sloshing around the continent, around the oceans. It goes somewhere, right? But liquidity on the financial markets is not like that. It can just evaporate. So why are we so confident in this TINA argument?
Sure.
Your proposition is entirely logical, Beatrice. We should be in a world where the U.S. should be suffering consequences for its policy volatility, its pushing away the rest of the world, and the diversification motive by itself should lead to a shift. And certainly what you're suggesting is a hopeful alternative where, in fact, Europe, and you put it in much better words, gets its act together, where China does the things that are necessary to develop the renminbi as an alternative currency, have renminbi liquidity easily available offshore, convince people that its institutions are going to be robust enough to protect the interests of foreign investors and so on. So as I said earlier, I don't think it's obvious that the world we are in is a world we need to be stuck in. But I fear that this transition to a world where you do in fact have what I call fragmentation, which Barry and Danny prefer to think about as a multipolarity, if that is not built on strong foundations, I worry that in good times it might work well, but in not so good times, especially a moment of crisis when there isn't a clear anchor to the global system, when there isn't one currency that everybody can coordinate on and that everybody trusts, there is a problem. So if you have multiple trusted currencies, I think we are undeniably going to be in a better world. And I hope we will get there, but I see that path as being very fraught.
So just to be clear, Beatrice, you and I are arguing the same thing, that the global supply of liquidity is elastic, which can be both good and bad, depending on what the nature of the shock is. And that means that TINA does not apply in this context.
We have time for one more question.
Thank you. Chris Walker, MAS. As you were discussing some of the alternatives that policymakers face, you mentioned the case of Singapore and how Singapore's strategies with regard to, I guess, reserves might respond to this. And I was thinking, how would this apply then to the situations of some of the other central banks that are represented here for countries in the region that are trade dependent but don't have very large stocks of reserves or net foreign assets? How should they be thinking about this? I guess there's some consensus that diversification is a good thing. What about the ARA metric that you mentioned, Professor Prasad? Should they be reconsidering what the standards for reserve adequacy are in this world?
On the last point, certainly the reality is that while many emerging market economies have in fact substantially improved their policy frameworks, have improved their resilience, the world is, as I mentioned, getting increasingly hostile. So there are going to be even more sources of shocks, even more volatility that these economies are exposed to. So the reality, I think, is that they are going to need reserves. Or they could find alternatives, such as regional insurance. But the difficulty, of course, that if you think about something like the CMIM, many of the shocks that the global financial system may be exposed to are going to have symmetric effects across the region. So it's not obvious that that is going to provide much insurance. But the deeper question is whether there is enough trust among all the parties concerned for the system to work well at a moment of crisis. And again, I think it's worth differentiating how things might look like in good times versus not so good times. And of course, the hegemon is creating not so good times and even more volatility. So diversification is one answer, but I think the prerequisites of liquidity and safety for assets really limits the pool to which you can diversify. If you're a smaller economy with, $50 billion worth of reserves, that's easier. The larger you get, the more reserves you have, and the sheer quantum, that becomes much harder to see clear alternatives.
So the same economies that have reserves above the ARA threshold are the ones who've been buying gold because they have a liquidity tranche and an investment tranche that they don't have to use, and they can move some of the latter into gold because it can sit there.
If there's any one more last burning question, we can entertain it. Otherwise, oh, yes.
I heard a little bit of a tension between the plumbing and what ultimately the private sector is going to do. And I wanted to come back to what Danny was saying, is that I think the biggest challenges on the plumbing side is governance issue. You mentioned nicely Enbridge. You could have mentioned AGARWAL, which is another club. Each of those are not compatible. So Enbridge, for example, has China in it, Thailand, Saudi Arabia, UAE. It invited the Europeans, and the Europeans said, we're not going to join the club. AGARWAL is another club, was founded in 2024. It has the US, Japan, Korea, Mexico. That sounds like a Western club. Each of them uses different technologies that are initially not interoperable. So the incentive for these jurisdictions are to create plumbings that serves themselves but not the broader system. Now, that is the plumbing side. Whether or not that will dominate at the end would depend on whether things like the stablecoin, US dollar-backed stablecoin, ultimately will still be the form of payment transactions. But I think the incentives right now are to create these different governance structures, and because we live in a world where we don't talk to each other anymore, we're creating clubs that ultimately will not be interoperable anymore.
Danny, you want to take?
Yeah. So just very quickly, I've learned not to be too disappointed when the world isn't optimal, that we just sort of stumble along on things that can best be done. I am not as pessimistic as you are on how some of these coalitions of the willing, rather than clubs, might remain open and potentially inclusive. So I give one example and then we can end. Project Nexus is centered around the idea of simply creating open APIs, application programming interfaces, that allow whichever IPSs, instantaneous payment systems you use in your country, to plug into. It is agnostic. It doesn't close off anyone, but it solves the quadratic cost minimization and makes it linear. That's a concept that seems to me scalable, and it's not against the possibility that these clubs are as inclusive as they can be. They simply come down to which coalitions of the willing want to come together. Singapore is part of Project Nexus, and I do not think that Singapore would want to sign up to something that would intentionally exclude others.
So someone earlier said the word governance, and I think that's relevant here as well. All of these platforms work from a technical point of view, but who's going to make the decisions about who gets to join the club and under what circumstances, and who is liable when something goes wrong? Those governance problems are going to be hard to overcome.
Okay, we'll stop here. Thank you to Eswar, Danny, and Barry for great presentations. Lunch will be served.